As we noted just minutes ago, you released an essay on the economy and monetary policy in which you say, at this juncture, having adjusted the policy rate twice this year, it is my intention to take some time to carefully monitor economic developments. That sounds like you're not convinced that you need to cut rates on October 30th.
I'll withhold judgment until right before the meeting. I was supportive of the July cut. Also was an advocate of the September cut. And the reason I was in favor of those cuts is I feel that decelerating global growth, weakness in manufacturing, weakness in business investment, there's a risk that those weaknesses may intensify and spread to other parts of the U.S. economy, and I felt it was appropriate for us to take some action. Now that we've acted twice, I'm going to withhold judgment here and take, we've got about 20 days to the next meeting, and I plan to take most of it to make a judgment.
Well, you also say in your essay, I believe that moves in U.S. market-determined rates are consistent with concerns about economic weakness spreading more broadly to other parts of the U.S. economy. Now, market rates, particularly Fed funds futures, have priced in a rate cut. Do you have to ratify what the markets are thinking?
No, the market rates I'm referring to are particularly I'm looking at the Treasury curve. And since the fall of 2018, over the last year, the 10-year Treasury has gone from 3.25 yield to a high 150s today. It's about 165 basis point rally. It's a substantial rally. In that same time, the Fed funds rate has only moved down about 50 basis points, at least since the beginning of this year. So we've had a substantial financial move in market-determined rates. I think some of it is global liquidity, but some of it is increased pessimism about future growth, mainly due to trade tensions. And no, I don't think the Fed has to chase that move. But I think it did tell me, that substantial move tell me that the setting of the Fed funds rate was probably too tight in July and September. It may still be too tight, but that's a judgment I want to make as we go through the next few weeks.
Well, given that investors are so certain of a rate cut, do you risk maybe a redux of the taper tantrum if you don't ratify what they do?
So I think the one thing you've heard me say before, market expectations can change on a dime. And I don't think my job is to satisfy the markets. It is to figure out whether we've got the right policy setting, particularly a setting that fosters economic growth. Also, other part of my job, by the way, is to call out it's not just monetary policy that has been a cause of this slowdown, and more than monetary policy is going to be needed if we're going to grow faster. And I'm talking about growing the workforce, improving trade and de-escalating trade tensions, and also other moves on education, skills training, and other things that would increase our ability to grow.
The minutes of your September meeting show a discussion about whether to put something in the statement or publicly suggest when you would end this cutting cycle. Do we get something like that? I'm not necessarily sure that that's appropriate. I think when you start hearing people like me and others say, I'm agnostic about whether we move from here, that would tell you that if nothing changes, we're going to stay where we are. But I think we've got so much uncertainty and so much policy uncertainty. I think it would be wise for us not to over-telegraph where we are in the cycle. I have said, though, that I thought that this cutting we're doing should be limited, restrained, and modest, and not the start of a full-fledged cutting cycle. I still believe that. Well, in your essay, you note, as the chairman did just a few days ago, that growth is being affected by slowing economies elsewhere and trade tensions in particular. So I have to ask a question I get asked all the time by people on Wall Street. What does the Fed get out of cutting rates? Because we're not suffering from an aggregate demand shortfall here. How do you help?
So I do think when rates are this low, Fed funds cuts, maybe the marginal additional effect might be less than it would be if rates were higher or credit conditions were tighter. But that doesn't mean that cutting the Fed funds rate doesn't have an impact. It does. There's still a substantial number of borrowers that borrow based on the short-term rate. And in addition, I've been concerned about the shape of the yield curve, particularly if the Fed funds rate is above the 10-year Treasury. and there's a substantial gap, it has a tendency to make it harder to borrow short and lend long. And I think that, if it was prolonged, would eventually cause a tightening in financial conditions. So sometimes when you're cutting rates, there is a short-term positive economic effect, but there's also you have to look over the horizon, particularly as to whether you think there's some distortion in the curve that I think suggests our policy setting's too tight.
Well, you're not concerned about running out of ammunition when we do face a downturn?
I'm worried about that argument, but I'd rather use ammunition when it matters most. And I've said a number of times, if we wait and withhold our ammunition and wait to see a broader slowing in the economy, i.e. we wait for this slowing to reach the consumer, and then we have a more severe slowing, we will have waited too long, in that all the ammunition we have, I don't think, will be enough to arrest that slowing. I think moving modestly now gives us the best chance to avoid a more severe slowing, and that's why I want to use the ammunition now, even though, yes, it means we'll have a little less ammunition for later.
We're speaking with Robert Kaplan, the president of the Dallas Fed, on Bloomberg Television and Radio worldwide. Dallas Fed's specialty is trade. So given the fact that everybody's talking about that as the source of our problems, can you quantify what it means? Is it a headwind? Is it an anchor? If they reach some kind of deal, does the economy turn around? If they don't, does it tank?
So here's the confusing or vexing thing about trade. If you just took the amount of goods we're talking about, say vis-a-vis us and China and other countries, and multiply the potential tariff on those goods, you'd say the impact on GDP growth in the United States should be very modest. There's a second order effect, though, we believe at the Dallas Fed is far more substantial, and that's the impact of trade uncertainty on business investment. And on manufacturing. And what do I mean by that? A lot of these trade relationships, particularly as I mentioned before with Mexico, are logistics supply chain relationships that are critical to the country. USMCA isn't yet ratified, but the uncertainty we've had for a good part of this year about trade with Mexico, we think took the wind out of business investment. And this trade dispute with China, which we think is very appropriate, intellectual property rights, technology transfer mean more to us probably than the size of the trade deficit strategically. But the uncertainty about that relationship and new events that occur every week or two that change the view on this, we find are causing businesses to say, let's just time out. Let's just put business investment on hold. I'm not going to cancel it, but let's put it on hold for this year, maybe all of next year. And that's why you're seeing business direct investment so weak. Now, that's not a huge part of GDP, business direct investment, but if that slows, it can start to seep in to other parts of the economy. So it's the second and maybe the third order effects from trade uncertainty and trade tensions that I think have a more significant effect on the economy, which is harder to measure.
It's time when businesses are planning for 2020. You suggest they're going to stay on hold. So What we're seeing now, the kind of growth, 1.7 to 2%, is what we get for 2020?
Our forecast for this year, at least for the second half of the year, is 1.7. And maybe it'll be in that neighborhood for 2020. I'm not sure what we see that will make it better than, say, 1 3/4 to 2%. And yeah, most businesses I talk to right now want to stay nimble, and they realize that there could be new policy pronouncements any time. And with that amount of uncertainty, they're not cutting back their business, but they're putting new projects on hold. And the other thing they're doing is watching very carefully if there's a broader slowing. And if there's a broader slowing they see, say, in the consumer, I think they're at least on their toes that they will take further action. And that would cause even a further slowing. So I think we're in a fragile period in here, which is why I'm glad the Fed has taken some action in July and September. But I think this could go either way. We can avert a more severe slowdown, but I think the jury's out right now.
In the minutes, you got a report on what happened with repo because it had been just a day or two before you met.
Yeah.
And yet you didn't discuss what to do. The chairman this week said you've reached some decisions that you're going to move forward. So did you have a conference call or something in between and make decisions and set things up?
So I'm not going to disclose things that haven't been publicly disclosed, other than to say at the time of the FOMC meeting in September, we announced these daily repo facilities. And just for people who are listening, what that basically does is help distribute a repo across the system, i.e. if big banks aren't lending their reserves in the overnight funding markets, a standing repo facility or a daily repo facility has the purpose of getting rid of those frictions. So we've been doing that every day. We are having more deliberations. I don't want to foreshadow those, but we'll be making some announcements in the very near future, not just about repo, but also about increasing the size of our balance sheet in a way that improves the reserve levels, especially in light of increased U.S. Treasury issuance, tax payments, and other frictions that we're seeing. So I think we believe, and I believe there's a need to do both, repo and increase the size of the balance sheet to some extent in order to raise the reserve levels. And we've lost reserves since early September, mainly because of tax payments and because of Treasury issuance. We need to restore some of what we've lost.
Jay Powell said you're not allowed to finish your interviews without saying, but it's not QE.
It's not QE, and he's right to say that, and it's correct that that's not the case, because we're just buying bills. If we do this, whatever we announce, we'll just be buying bills, whereas QE historically has been buying securities out along the curve in order to lower those term rates in order to incentivize maybe mortgage lending and risk-taking. This will be just related to bills and primarily targeted at the overnight funding markets and making sure we can appropriately set the Fed funds rate in the target range.